U.S. data reports were out earlier this month, and they raised some hope for the economy. But our director of economic analysis, Bob Johnson, told Morningstar.com that he's actually not the most optimistic guy around right now. I have him on the line. Bob, thanks so much for joining me.
Great to be here today.
So let's start with U.S. government spending, which represents about 20% of the GDP. So what's your take on government spending right now?
Right. I think government spending, this recovery has been a big impediment. A lot of people say, well, housing's been the biggest impediment to growth, but actually it turns out that it's government. And government sector almost always grows in a recovery, and this time around it has not. In fact, it's taken 2, 3, 4% off GDP growth every quarter since the recovery began. And so it's been a big hurt, and it's hurt employment as well. We've lost 600,000 jobs in the government sector here in the U.S. since the recovery began.
All right, well, let's switch gears and talk about the U.S. consumer. There was a bunch of really interesting headlines out yesterday about consumer confidence being the highest in 5 years. Actually, I've written down here, the Conference Board, a New York-based research group, said that its consumer confidence index rose in May to 76.2. That's up from a reading of 69.0 in April, and that's the highest since February of 2008.
Yeah, I'm very cautious about interpreting consumer confidence numbers. I am a much bigger believer in analyzing what consumers actually spend, because I can get what they're spending in real time, faster than I can even get, say, compiling the survey results. And the surveys have not been very predictive of the economy. They're kind of maybe a little bit concurrent, but they certainly aren't leading indicators of the economy. Instead, I like to focus on weekly shopping center sales for short-term confidence. And like I say, I've already got the data. I got the data through Saturday this morning, and those numbers were okay, but not great. I look at auto sales for the intermediate-term consumer confidence. And those numbers have gotten rapidly better over the last 3 or 4 years and now have stabilized a little bit. We'll talk about that. And then finally, for long-term confidence, I look at the housing industry. And that's the best way to do it. If you stick a microphone in somebody's face and say, what do you think? Or you sit there with a clipboard, they're going to say what you think they want to hear. And you're going to focus on whatever the most recent headlines are in the market. And I really think they've been proven to be an incredibly non-useful statistic. I do not comment on my website anymore because the data is so bad and so useless.
And I guess for media and for investors, consumer confidence is always so interesting since I believe it represents about 70% of the U.S. economy and spending.
You know what? It does. And I watch a consumer like a hawk. But you ask consumers what they think they're going to spend in the year ahead, and it's terrible. But you ask them, I mean, it's a terrible predictor. But you actually watch what they're doing and the trend line growth in what they're doing. Now you've got an indicator. And like I say, we're just a little bit soft on that front right now. The year-over-year weekly shopping center data got under 2%, which is the first time that had happened since the recession back in February and March as the payroll tax kicked in. And now we've slowly started to come back, but we're still not, the retail sales growth is not what it should be. And I think people are getting a little bit too excited about the consumer here in the U.S. right now.
Okay, well, let's take a look at a predictor that you do like, which is auto sales.
Yep. And again, that's a great intermediate term predictor. And remember, our theme here is trying to look at what may be a little softer than people think in the economy. And I think auto sales have been a big help to the recovery. We've gone from a 9 million sales level at the bottom to 15 million or so right now. And in a typical boom period, we might be running about 16 to 18 million units. So we've come a long ways, and we've only got a little ways left. Autos so far have been probably the biggest single biggest jump in GDP growth of all the other factors. And now, yes, we're going to have growth, and boy, we're in a lot better shape than Europe. But I think the times of having, kind of 10 to 15% year-over-year growth and the big jump off the bottom, those are over. Autos will grow, thank God, but they won't be as big a jump as they have been in the past. They're going to be a smaller contributor, and something's going to have to make that up.
Okay, and another indicator that you like is housing. So what's your take on housing right now?
Yeah, housing's interesting. I think that it's doing very well. I'm pleased with the data. It's certainly been an adder to the economy for the last year, and I think it will continue to be a nice little adder, and it may offset some of what I talked about earlier with the auto industry. But the one issue I have there is I keep telling people, we'll get it one way or another with the housing industry. Either prices will go up a lot or housing starts will go up a lot. We probably won't get both, because if you start too many new homes, that's more supply and it'll keep a lid on prices. So the prices can't go up, but if you don't start enough homes, which we're in right now, then you tend to have higher prices. So it's a very interesting win-win situation kind of for the consumer. Either you get more home building, which is good for the economy, or you get higher prices, which is good for the consumer. Now, the one thing that's got me worried, why I'm a little worried about housing right now, is that especially on the new home building side of the equation, which would help employment more, which is where I'm really looking for the help, there seems to be a shortage of available land, available labor, and supply chain bottlenecks that are really kind of holding it back. I had a forecast of 1 to 1.1 million home starts here in the U.S., and here we are kind of May-ish, and it doesn't look like we're going to have a month over 1 million yet, which means we have to get to 1.2 million kind of in the back half of the year, which sounds a little bit high based on the data that I'm looking at right now. So I think housing is doing well. It will help consumers feel good. It's why confidence numbers are better, because their prices of their homes are up. They're feeling they can go out and borrow against their homes, remodel their homes a little bit. But unfortunately, it's not helping new housing starts as much as I had hoped.
Okay, so now I know your take on auto, and I know your take on housing and the GDP of the U.S. government. So overall, how are you feeling about the economy in 2013?
Well, I'm thinking kind of 2% growth for 2013, which isn't very much different from what it was in 2012. I think some people have kind of kept raising their numbers, and they saw the 2.5% in the first quarter, and they're thinking, oh, maybe we'll get better in the second half as the world economies come back. I really think that 2% to 2.25% is probably upside on the U.S. economy, specifically because of the issue in government spending holding things back more than anything else. And certainly the world economy is not providing a tailwind anymore.
Yeah, okay, thank you so much. That was great, Bob. And next time we chat, we'll have to take a look overseas. We'll talk about China and Europe next time.
Okay, very good. Thank you.